I made $400,000 in 1 year using this exact trading system. And in this video, I'm going to completely reveal it. No gatekeeping. This is the system that allowed me to finally become profitable after years of failing. And we're going to cover the rules of my system, my strategies, how I enter and exit trades, and we're also going to go over multiple trade examples so you can understand how to use this for yourself. Let's get into it. If you look over here, you can see my funded accounts, how much I was profiting from day to day, and these are just a small example of some of the payouts that I received from some of those accounts. So firstly, let's talk about the rules and principles that you should have in place before you even begin trading. And by rules, I mean just following a simple set of rules to ensure that you are trading based on actual metrics and not just off of emotion themselves. And with the first rule, and I think that this one is the most important, is your max risk per trade. You should decide how much your max risk is before you even click buy or sell. You need to have this risk to reward system in place so that way you're just not blowing all of your accounts in one trade. Let's say you're trading on prop firms, and with the 150Ks on Top Step, you're allowed to have $4,500 worth of drawdown. You should not be blowing that account up in one trade, and you should at least give yourself 10 swings before you're able to blow that account up. With that $4,500 drawdown, and if you give yourself 10 swings, that's risking about $450 per trade. You can take 10 trades risking $450 before you would lose that account. And that's saying that you would lose every single trade in a row before hitting a win. The next most important piece is your max trades per day. You should cap how many trades you take in a session before you're satisfied with your gains or it's just not your day. Take 2 to 3 quality setups, which is a lot better than 10 random ones, and you will start to see some sort of success just by taking a couple, waiting for 2 to 3 quality setups. Patience pays in these types of markets, and if your setup isn't showing up, only trade your setup. If your model doesn't present itself, don't trade. It becomes a lot more clear when you have these systems in place just by waiting for certain setups and acting on them when they happen. I guarantee you there is at least 2 to 3 setups in a given trading day. And if you are just patient enough to wait for them setups to appear, you will become profitable. Now that we've kind of talked about some of the principles and rules that you should kind of follow, let's talk about the strategies that I trade on a day-to-day basis. Starting with strategy number 1 is the IFVG strategy. You wait for a liquidity sweep, can be session-based or time-based liquidity, wait for price to invert that fair value gap, enter on that fair value gap inversion, and target opposing liquidity. And with the next strategy is the opening range break. You take the first 15-minute candle of a trading session, wait for 5-minute fair value gap to get created through the range. So we're looking for displacement, and you can enter on that fair value gap creation or wait for a retest of that fair value gap and enter there. You have one strategy to help you catch reversals, which is this IFVG strategy, and you have a strategy to help you catch expanding markets, which is this opening range break strategy. We'll go over on TradingView, and just to show a couple examples, we'll dive into more throughout the month, but here, this is that first strategy with the IFVG. We swept out this previous daily high. And if we drop down to a lower time frame, you can see clear fair value gaps created into that high. And what did the market do once we took that buy side liquidity? We got an instant reaction. We created a bearish fair value gap, inverting all of these bullish fair value gaps. And market didn't open up until right about here. And this is just today's price action, or October 7th. And so what you would do is you could either wait for the retest, or if you got in right on the inversion, you'd put your stops at the swing high, targeting opposing liquidity, which in this case was session based and time based, and we also had a previous daily low sweep down here below. So kind of with some discretion on how far you want to take your take profit, but this is what you want to see when you're trading with this model, is you want to see price come up into an area of liquidity and instantly reject it. Here we created this 5-minute bearish fair value gap, and we also came up and tested it, respected it, and started to continue legs to the downside. And so it is very important to have your stops at the most recent swing high of the inversion. That way, if we make a new high, then this trade idea is invalidated. Not to say that we can't take out liquidity again and then move in the direction, but this one was textbook. This is what you're looking for when you're trading this model. I mean, we took buy side, we inverted fair value gaps, and target sell side liquidity. It would have taken a minute to play out, but the model worked in this scenario. And then kind of the same thing within the same day with the other model is we take our first 15-minute candle, and this can kind of add some confluence to hold your trades longer. Like let's say you did take that first IFVG, you take your first 15-minute candle of that session, which would be this candle right here, and you can simply just draw a trend line at the high. And if you want, you can mark it out orb high, orb low. And then from there, what we do is we drop down to a lower time frame. So if you notice, you don't enter in on the wicks below that high or low. You wait for clear displacement through the range. This candle right here created a small 5-minute fair value gap. It's very small, but we created that displacement. Notice these candles that we're printing, they are big red candles, and we are getting clear displacement through that first 15-minute range. So as soon as this candle closed, what you could do is you could either wait for the retest, and in this trade idea, it didn't happen. But what you would do when you get that clear displacement, whether it's here or here, to manage risk, what we'll do is we'll put our stop loss at that candle that caused the displacement through the range. We don't want to see price come back up into the range, and because if it does, that kind of signals that the move isn't ready to happen, and this will help us allow us to manage our risk and basically give us more swings at the bat if we are wrong. And so here you have your IFVG entry, and then in confluence to it, we have our orb break. This adds confidence that even if we took the initial trade, that this is going to move in our direction towards some sort of sell side liquidity. And so now that you kind of have a little bit of an idea of my strategy, let me show you how I find entry points. Okay, so here are some entry signals that I've provided, and the most important thing that you should be looking for when trading the IFVG model is you need that liquidity sweep. No raid, no trade. If we do not take liquidity, our model is not valid here. We need that because there's resting orders above that liquidity. And so retail traders are buying above that buy side liquidity in this scenario. And what happens is institutions hit that sell button and start targeting where those retail traders would put their stop loss. So you can see in this example, we have a lack of displacement on that given time frame. And what I mean by lack of displacement is we are failing to close any large green body candles, or in this case blue, but we are failing to close any big body candles over this area. And so that kind of is a key for me that price is going to start moving in the opposing direction. And you don't enter in on the liquidity sweep, you wait for your confirmation. So once you have your candle closed through the IFVG, then it is time to go. Then you can click that sell button and you can start seeing after taking that liquidity, we have our entry signal down here and we're getting clear displacement. After taking that liquidity, look at what price is doing. It is aggressively starting to move in the opposite direction. And this is the example that I had just shown previously, but we took previous daily high. What did price do after it took previous daily high? We inverted, we disrespected all of that bullish momentum that we were creating, and we created bearish fair value gap. Price retraced into it, had a deep retracement. So as soon as you entered this trade, you would put your stops at the swing low, targeting opposing liquidity. We took buy side, we inverted bullish momentum, respected the bearish fair value gaps created, kind of allowing us to see clear direction on where the trend was going. And I mean, it's rinse and repeat. Same thing with entry number 3. There is some buy side liquidity taken over here. We inverted our fair value gap. There's our entry signal. As soon as we get that candle close, and then here's the follow through. Whether the sell side liquidity is down here, that's all we're looking for. It doesn't have to be such a large move, whether you want to target a fixed 2R or into some sort of higher time frame bullish fair value gap. You are just looking for some sort of sell side liquidity on a given time frame. And I've kind of found this to work out really well on the NASDAQ, as well as even in the crypto markets. And with my strategy number 2, I almost want to say that this is one of the hottest strategies that people have been talking about, or that a lot of people actually trade this. And that is just the opening range break. You can do this on the 15-minute, the 5-minute, the 30-minute, and with that you need some sort of time frame alignment. And what I mean by time frame alignment is if we are looking for the 15-minute opening range break, you would then drop down to the 5-minute time frame. Most of these examples are with the 15-minute opening range break, and you wait for clear displacement through the range. You can see on this candle right here, here's the high and the low of our 15-minute range. And what did this candle do? We created a large body candle, creating a fair value gap and retesting it. And what you would do is you would enter your trade. You can either enter on the fair value gap creation or wait for that fair value gap retest. And so what you would do is you would enter here on that fair value gap retest and put our stops at the candle low that caused that displacement. And it's the same thing on the rest of these entries. We have our first 15-minute high and low. And the key to this strategy is just because we have a candle low but close below this opening range does not mean enter that trade. We need a clear sign of displacement. We need to see a clear break in structure. And so here we have our first 15-minute range. If you would have entered here, you would have been stopped out. And then with this candle, we created a fair value gap through the range. This is our sign of displacement that we are going to look for continuation. So you would wait for the next 5-minute candle to then close to confirm the displacement through that area. And you could either enter in as soon as this candle closes or wait for the retest. A lot of people like to wait for the retest because the trade might run another 30, 40 points and then come all the way back down to their entry or even retest this fair value gap. And so learning how to manage your emotions when price runs and then gives back all your profit is just something you'll learn how to do when you're managing your emotions and trade. And me personally, I'm the type of person that waits for the retest because it's more often than not that I see price expand and then come down and retest the fair value gap. And same thing with here. We had our displacement candle. Your stop loss would be at that candle. Here's our fair value gap confirmation. And what did price do? Here is our confirmation. It trades up a little bit and then we get our retest. You would enter in on the retest of this fair value gap and then put your stop loss at the candle body that caused that displacement. And like I was saying previously, because if price trades back down into this range, we don't really want to be inside that type of trade. This allows us to manage our risk effectively, and you can either target the next high in structure or go for a fixed 2R. So with this being said, I think it would be really beneficial to see some more trade examples from me, just so you guys can start to understand how these models really work and what exactly I am looking for. So let's dive into some replay. I have these market sessions up just for simplicity so you guys can see when I say time-based or session-based, it's simply off of using the Asia range, the London range, and the New York session. And these are the time zones that I use for my sessions. London is 0 to 6 a.m. and this is all on GMT-4 too, which is Eastern time. And we run New York on 6 to 18 and 18 to 0. And typically what we'll get is we'll have our Asia range. London will then manipulate one side of the range and we can start to look for us to come down towards some sort of that other side of the opposing Asia range. And so this is just for simplicity reasons to show you guys where the sessions are and how I kind of find my trades based on that. And so let's get into it. So for this scenario, we can see that the Asia range was here. Our London session has came down and here's market open. So we're going to take our first 15-minute candle, mark out the high and the low, and use this as our gauge. We have taken sell side liquidity from over here. And so how is the market going to react? We have inverted a fair value gap, but is this the correct sell side liquidity that we are looking for? Let's just play it through. We will then drop down to a 5-minute time frame to see if we get that clear displacement. Let me mark out the orb high and the orb low. And so if you look here, we did create a fair value gap through the range, but instantly disrespected it. There was no signs of respecting it here. And on a smaller time frame level, we also came up and grabbed some liquidity from this high. And so if we keep going, no fair value gap created through the range. Here we have some more liquidity down here. And you could either look for that IFVG model on the M1 or the M5. So there was no entry for the orb in this scenario, but notice what price does as it comes down into that sell side liquidity. Right here would be your entry model. we have an inverted fair value, or we have a fair value gap, came down, took out some sell side liquidity. When using the IFVG model on the 1 minute time frame, it can really help you manage your risk. Like in this scenario, you would have 20 points of risk and you're targeting up towards these highs or up into some sort of bearish order flow. If you feel comfortable going BE here, and if we start to look at different time frames, we can see that we have a M5 fair value gap. So those are just things to be aware of when we are looking for reversals and we have all of this bearish order flow in the way. So like in this scenario, we took out sell side liquidity from over here, which would be a previous daily low. This is Friday's low, so not previous daily low, but we swept out a low. And then look at the reaction off of this. So as we start tapping into these fair value gaps, this is where you want to start to manage your risk. This is probably an okay area to set your risk to BE, which, and what I mean by that is before entry. So that eliminates all risk on the trade. Then what you can do is start to target that opposing liquidity. And so this one actually did end up retracing pretty much to where your entry would have been. But if you don't put your stops to entry and just leave it mechanical at that swing low, this would have worked out. And then we start flipping to other time frames. And if you look here, after sweeping out that sell side liquidity to add confluence to our long idea, we have also inverted a 5 minute fair value gap and kind of just starting to look at other time frames. And really where that buy side liquidity was as well was right into a 15-minute fair value gap. And so these are kind of areas where you would expect the market to react or reject. And I mean, let's just see what happened once you tapped into that high. It kind of played around a little bit, dug into that 15-minute gap. And I mean, regardless, your trade idea would have worked at least into this first set of buy side liquidity. And I mean, as the trade starts to move in your direction, that's just kind of where you start to manage your risk. You take some trims, you secure some of your profit as that trade moves in your direction, because as we come into those higher time frame bearish gaps, those are areas where we could look to see price reject off of and so forth. Let's dive into the next day. So coming into the next day, here's New York Open. We are on our 15-minute time frame. We'll draw in our orb high and our orb low. And it isn't all the time for the IFVG model that you have to wait for New York Open, but for simplicity reasons, it's honestly better to just wait for that open, just in case you get some sort of manipulation during that opening bell. So here we have our orb high, here's our orb low. And I know I just said that it's best to wait for the open, but if you look, we swept out that previous daily low. Here's this previous daily low again. And what did the market do? We are on the 1 minute time frame. Here's our sell side liquidity / previous daily low. And what did the market do? We took that liquidity and we instantly started getting some sort of bullish momentum. So let's say you did enter this trade a little bit of pre-market. You would wait for the IFVG to confirm. You would enter your long position as soon as you get that candle close and put your stops at the swing low. And as the trade starts to develop, you have clear areas on where you can look to take profit. And then as you come into the session, since this is a pre-market trade, here's our orb confluence. And let's say we entered in this trade down here. You could then wait for clear displacement to the upside. And here's our orb break. We had then created a 5 minute fair value gap, displacement through the range, retested, and continued. So if let's say you were to enter this one, you would then enter in on the retest and put your stops at the candle that caused that displacement through the range. And we would then be targeting up towards these London highs because this is some time-based liquidity. And let's just see if this were to work. Straight through the range. And so this kind of just shows you that you can use both these models in the same way. Yes, we took out that sell side liquidity. So now we start to look for our reversal model. If we were still holding this trade and into the New York Open, then you could start to look for that orb confluence and use the models together in order to hold your trades longer if you were to enter this one. And so both those ideas would have worked out. And once price started trading up above these highs, it kind of calmed down. So like that was like the move of the day. But I'm just trying to show you that you can use both these models together, and it really helps you determine how long that you can actually hold your trades for. If you start to get both confluences together and you get both the models, there's no reason to just take profit right away as soon as the trade starts going in your direction. And this allows you to start targeting other points of liquidity and managing your risk as the trade moves in your direction. So starting in with the next day, here we have our orb high, our orb low, and market is trading at all-time highs right now. So that is just something to be aware of. We've taken all of the buy side liquidity over here. And what is the market going to do today? Are we going to retrace and reverse after taking all-time highs? Which is not really something I advise. Most people, as the market continues to make new all-time highs, it's their first instinct to just click that short button. When in reality, if you just continued to click that buy button, you would outperform a lot of traders just by buying at all-time highs rather than trying to short and try and catch some sort of retracement. Because ultimately, right now, the market is bullish. So we don't want to just short into strength. Like, the market has shown no signs of wanting to turn around yet. But for this scenario, we have our Asia range. London manipulated one side of the Asia range. We came down and we ended up sweeping out this London time-based or session-based level. Time-based, session-based, in this scenario, it's the same thing. So we have our orb high and our orb low. We then drop down to the 5-minute time frame, wait for a clear crack in displacement. Here's our displacement candle. Once this candle forms, you could then go long. We'd put our stops at the low of the candle that caused that displacement. We would then target a fixed 2R. And in this scenario, it goes right to it. So right here is your fixed 2R. This is where you would secure your profit. In this scenario, we didn't retest that fair value gap. This would have been an entry as soon as you got that fair value gap displacement through the range. And so in this scenario as well, we are approaching all-time highs. We are above all-time highs. So what is something that you could expect the market to do? If we aren't looking for reversals, we are looking for an expansion. And that's why this model works out so well in an expanding market. Because if the market is bullish and the market is going to continue going up, we already swept out sell-side liquidity down here. So for your IFVG model, given that this was at 6 in the morning, likely you aren't looking at the charts yet, you still have some sort of model, entry model, to then base your trade idea off of that New York session. As you come up into that fixed 2R, this is just kind of where you start to manage your trade. That should be an area on where you secure profit. We don't want to be greedy when trading these models. A lot of people and a lot of new traders, they're trying to get rich off of one trade, and for longevity reasons, it just won't work. You take your win and you come back the next day to essentially implement the same system. So coming into the next day, you can see we have our Asia range, we have our London range. There's liquidity resting below each session. And as the market comes through and opens up, we swept out all that sell side liquidity. On that 5-minute time frame, we are getting a lack of displacement. If we then drop down to the 1-minute time frame, this isn't the cleanest reaction, but the model is there. So let's say we entered our trade here. So we swept out that sell side session based liquidity, and we have our 1-minute inverted fair value gap. You would then put your stops at the swing low and targeting some sort of buy side liquidity. To this high isn't the best risk to reward, but if the trade is going to start moving in our direction, this is where we can look to eliminate risk. So as price were to come up in here, we would then take our trade BE and eliminate all the risk for the trade and basically protect ourselves and allow us to swing again if another opportunity presents itself. So as well as the orb range coming in, we take our 15-minute candle, draw out the high and the low, and then we simply just wait. We simply just wait for our model to confirm orb low. And if you were to enter that trade pre-market or right at open, you would already be in. And so now we just, like I said, we just wait. So as soon as we come up into that orb high, this is an area where you could look to secure some profit or put your stops to entry, eliminating all your risk and basically getting away with a win to start off if you wanted to trim at those levels. And if we went BE, we would have been stopped out. But this is that first set of sell side or buy side liquidity after taking out sell side. So eventually I would have been stopped out, and let's see what happens going forward into the market. So on this given day, the orb model didn't present itself, so we would not have taken that trade. Our IFVG strategy off of the lows came straight to this buy side liquidity. And then look, This can help you gauge and read price as well. Like we took out this buy side liquidity, and then what did the market do? We lacked displacement, we inverted a fair value gap, and these ones are a little bit trickier to catch because we're not taking out any higher time frame liquidity, we're not coming into session based, it's really just reacting to what price is doing at intraday highs and lows. So we came up above this high, we have our IFVG entry here, stops at the swing high, and basically targeting back towards the lows. And so this would have ended up working. We got our retest and straight to the lows. And so those ones are a little bit trickier to catch. And honestly, they don't have that high of a win rate just because you're not taking out any serious signs of liquidity. And like, if you look here where we started to reverse from, we are in these higher time frame fair value gaps. So price traded into these, balanced them out, and this candle right here is the wick of that previous 15-minute candle. The next candle came up, swept that high, inverted the fair value gap, and traded to the downside. From here, you would start to target these internal lows, or if we just look left, we have clear lows over here that have not been swept yet. It's not every day that you get that opening range break. And if we just look at what price did, it looks to have been a pretty choppy day and started to fall off towards the end of the session. And so learning how to manage your trade as price is kind of just chopping around and not going straight to your take profit. You know, that's where you have to kind of be aggressive or just see it through. You have your risk determined. And do you feel like taking profit at certain lows? You know, as you get later into the session, I understand that it gets a little bit harder to watch the screens. And I'm always the type of trader to where see green, take green mentality. And so if I have my entry models and we start taking out some sort of sell side liquidity, I don't really want to see price trade all the way back up into here. You know, this took 2-3 hours for it to trade back up into that area. But the whole time you're down here, you're seeing profit. You're seeing 50 points in your direction. And then to see it retrace like that, it takes a mental toll. So even if you take profit down here, I mean, we took out sell side liquidity, and then what do we do in the opposing direction? We took sell side, we inverted a fair value gap, so you could look to long here, stops at the swing low, and you know, personally I would have been targeting up here, but once we start coming up into these highs, this is where you start to eliminate your risk. These are areas where you start to put your stops at break even to eliminate all that risk, basically giving you a free trade. You're allowed to take profit anywhere above this high. You could trim and then set your stops to break even and manage the trade from there. And eliminating that risk is, I would say, the most important piece because you're in a winning trade at this point. You don't really want to see the trade turn red. That is a big no. And let's go over one more day just to see if we can spot some more ideas. So here's our opening candle. We mark out the high and the low of that first 15-minute candle, orb high, orb low. And so even coming into the session, first thing I would notice is that we traded above the Asia range. London has came above it. And what did price do above this area? So we swept out this session-based liquidity. And these ones are a little bit harder to catch, honestly, because these are at hours where I'm not typically up. But a lot of times you will see that London manipulation happening and you're able to snag your trade before the New York session if you are a London trader. And then even from here, you could watch how we react at the London lows, because this is the next set of sell side liquidity, and target Asia lows. If we start getting displacement through these areas, that is what you're looking for to add confirmation that the trade is going to go in your direction. But most of us are trading that New York session, so let's just see what the market wants to do during our session. We have our orb high and our orb low, no fair value gap through the range. And this is why it is so important to not take the trade unless you have that fair value gap through the orb high or the orb low. Everybody that got in on that candle close would have ultimately gotten stopped out. Price didn't give us clear displacement through the range, and now we're trading all the way back into it. Still no displacement through the range. This is likely going to be a choppy day. If it's already 1-2 o'clock and we still have no break in the range, I wouldn't be looking for that orb break. This kind of just tells me that we're getting a lot of fake outs. We're getting no displacement in either direction. This is not really a market that I want to be in. And just off of this reaction, I mean, we could come all the way to this candle. Watch what happens when we take out this internal liquidity. So market swept that high. If we drop down to the 1-minute time frame, or you know, you could do the 2 or the 3 to show that clear inversion. So there's our IFVG. We get the retest. enter in on the retest, stops at the swing high, targeting some sort of sell side liquidity. The moment we make a new low is where I would look to put my stops to break even. I don't want to see the trade start to push up back into this area if I am in on the right timing. The price goes through, comes down to that low. Now we set our stops to break even. We eliminate all the risk. And like I said, these ones are a little bit trickier to catch, but there is some management that you can do when looking for those trades. And so that one didn't end up working out all the way to the lows, but it came to this first set of sell side liquidity after that inversion and ultimately didn't work out. But since we put our stops to break even, we were able to eliminate all our risk. It was basically a free trade. So now that I've shown you a few examples of how to look for the models, how they work together, and how you can use them to add confidence to your trading and basically allow you to hold trades longer, and how to manage your risk when looking for those strategies. The next topic I want to talk about is I quickly want to mention is mistakes that beginner traders make. And most beginner traders are always chasing trades. They are jumping in trades without that confirmation, mainly because they are scared. They don't want to miss out on the trade. And if you're patient and just wait for the market to show its hand, it becomes a lot more easy to manage your emotions and act in the market with confidence. And with that, it's only trade when your system lines up. If your system isn't in line, you are basically just in the water. You have no clear direction. And if I'm taking trades where my system isn't there, I'm not confident. I feel anxious. I feel like the market is out of my control. I don't have edge. And when I don't have edge, it's just good things are not happening to me in the market. And with all of those strategies that we went over, they don't have a 100% win rate. If people had models that were 100% win rate, everybody would be rich. Everybody would be wealthy. And that's why that risk management is so important, because if one model fails, it allows you to swing again in the market if your system presents itself. And so it is normal to take losses. You have to get used to taking those losses and essentially not getting emotional when you take that loss. As you go through the motions of trading, you learn that it is normal to lose. And if you lose and you followed your system, it was a good trade. I would never complain if my model presented itself and I took the trade, I managed my risk, and I took a loss, because I know that the market is going to be here tomorrow. The market is going to be here next week. It's going to be here next year. There's always going to be opportunity in the market. The worst thing that you can do is blow your accounts up so you can't trade tomorrow. The next mistake that a lot of people make is that no risk management. A lot of beginners, they risk way too much on one trade and fail to set stops. I would know. I used to be that trader. In my previous videos, I explained how I had lost over $100,000 in the market. And that was simply just by over leveraging myself and having no risk management. Yeah, it worked for 3 months, but then once I blew it all up, I was depressed for the next 6 months, wondering why this isn't working for me. And it was simply because I had no rules on risk management. And so while I was feeling like I was doing something good, ultimately it ended up hurting me. And so that's why it's very important to determine how much you're willing to risk before entering the trade. And you have to respect it. If that trade hits your stop loss, respect it, move on to the next idea. Just because if it hits your stop loss and the trade starts going in the other direction does not mean re-enter that trade without any sort of context. And lastly is that revenge trading. I was kind of just talking about it. After you take that loss does not mean to take another trade right away just to make it back. I think it is very important to set a daily stop loss rule where if you hit a certain number in loss, step away for the day. Come back tomorrow with a clear mind and wait for your setups to appear. This will protect you. That daily stop loss rule will protect you from taking unnecessary losses and blowing up your accounts. This one is very important for newer traders too, because they want to just keep trading. They want to just keep making that loss back that they took on the day. And then eventually they blow up their account and they're going through the whole process again, wondering, why isn't this working? Why is the model even valid for me? Does this model work? And it's simply just because you're over leveraging. You're putting up too much risk on your trades and not really giving yourself any room for error. And when you're doing that, it gets to be very difficult when you're trading. And so That is the full trading system that has made me $400,000 in 1 year. I revealed everything from the rules, the strategy, and I gave you multiple trade examples so you can really understand this and use it for yourself. And so be sure to subscribe to this channel for more free sauce. Thank you.